All right. Good afternoon, traders. excuse, excuse me, still fighting a little case of the flu. Welcome out to the Tradespoon Active Investor Workshop Series. My name is Scott Beck. I'm the head trading coach here at Tradespoon. I will be your host as we talk about option Greeks, one of my favorites. I'm an options guy. I speak fluent option Greek. A little different from the traditional language, but that's what we'll be talking about today. Let me know if you can see my screen and you can hear my voice so that I know that this is coming through. I believe you can see the screen. Go to webinar tells me you can see my screen, but I just want to make sure. Yes. Hello again to you, Phil. Glad to hear you that it's working. Hello. Okay, good. Thank you very much, guys. I appreciate it. Glad to have an active group. Looking forward to today. As I said, my name is Scott, and I will be your host. Let me give you a little background. This is a little bit more formal than my normal background. I have been working in trading since 1999. I started off working for a large national broker. I worked on the trading desk, specifically on the options desk. I have gained experience trading in stocks, futures, currencies, and lots of options for the last, actually going on 16 years now. I've worked as a trading mentor, having coached thousands of students, successful trading principles and strategies. Yeah, my slides are old. I'm at 20 plus and 16 plus for trading and teaching. That's me. Oh, didn't mean to turn that off. Sorry. Let me turn this back on. I need my slides. I'm used to turning it off after the intro. I do also need to remind you that trading, and options in particular, involves substantial risk and may not be suitable for all investors. Please read characteristics and risks of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risk, be willing to accept them in order to trade in these markets. Tradespoon and myself are not investment advisors. We're not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin, interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and or the team at Tradespoon may have a financial interest in the securities presented and the trade picks. Vlad Karpel, Tradespoon founder, is also an investor and consultant of AOS Inc., which does business as Trading Block and Money Block, a FINRA and SIPC member broker-dealer firm. Tradespoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Okay, so this presentation used to be way more formal, and you're going to see I've taken that out. I believe the best way to learn the Greeks is to jump in, roll your sleeves up, see exactly how they work real time from the trading platform. First we want to do is talk about 7 pillars of profitable trading. This is the way we like to start all of these workshops, choosing what to trade, what product, what sector, what stock, etc. That actually can come from this. Some of my best trades are what I call free trades. They're trades that I don't go search and find a stock and build the trade. They're trades that come because I recognize through portfolio management, and you're going to see later on down the road here, that's what we're talking about. But when I look at my portfolio Greeks, I can see, where am I exposed to risk? Is it based on direction of the market? Is it based on time? Is it based on volatility? Where do I need to be concerned? So choosing what to trade can definitely come from a better understanding of the option Greeks. Position management, closing and trimming positions, that's really, risk management. Position sizing, stop losses, targets, scaling in, scaling out, things like that. Avoid chasing the market, don't pile into established trends. That's your technical analysis. That's when the model comes into play to help us out. How do we make better decisions and not be late to the party? Be patient, maintain a long-term focus, talking about psychology. If you haven't gotten to the point of how important the mental side of trading is, you will. It's one of the most important things, and in my opinion, 85 to 90% of mistakes traders make are literally self-sabotage. We do the wrong thing at the wrong time for the wrong reason. Know how to manage and hedge your portfolio. Again, how can we manage and hedge if we don't know what we're managing and hedging for or against? And that's where the Greeks can become really, really helpful to us. Properly manage risk and reward on every trade and from a position, from a portfolio basis. Lastly, make sure you have a trading plan that is written. If it's a mental plan, it's not a plan, it's an idea, it's a notion, it's not a plan. Make sure you stick to it. Make sure you execute that plan with complete and total discipline. So those are the things we're attempting to address. We're not going to get much into the toolbox today, but the toolbox is one of the most important things. It's one of our best tools. There's no other retail product like it because it gives us real-time predictions, easier way to analyze a chart, helps us predict prices for the next 10 days or the next hour, helps to identify key support and resistance levels, and helps us understand if the model is going to change. So what I tell people, we used to do these weekly. I miss it. Now we only do them every other week, twice a month. But it's great because I get to see people that I work with in the trading room, but I also get to meet new people. Those of you who are maybe looking into Tradespoon, trying to see what we're all about. This is the crux of it. This is the tool that Vlad built over years and years as a market expert and mathematician. I think it's a great complement to technical analysis. It helps to maintain objectivity by getting basically a second opinion. And if you don't think a second opinion that is objective relative to your own is important, again, you will get there. But what we're talking about today is Greeks. And I'll tell you, this is kind of coming from having taught the Greeks for 15 years now, having learned them myself and thinking back, and I'm going to show you a couple of different things, but we're going to go straight to the platform. So if you have any questions about the Greeks, delta, gamma, theta, Vega. Now we're not going to talk about rho, R-H-O, rho. Rho is a Greek that a lot of people haven't even heard of. But rho tells us how trades are sensitive to changes in implied changes in interest rate. Sorry, Vega is volatility. Rho with an R for rates, right? I'm going to give you those little tricks to help you remember, but R, rho, interest rates. If interest rates change, how will that impact the option prices? Why do I not want to talk about that? Because the Fed has literally come out and said there's a chance that we don't move rates this entire year. So if rates aren't going to change this entire year, then we're going to see pretty much stability in the bond rates. Now, some people use the 90-day T-bill, some people use the 1-year T-bill. They're not that different. But essentially, when you think about interest rates and the impact they have on option pricing, remember that in order to assess time and time value, we need to understand what time is worth. Well, the way we assess what time is worth is by applying a risk-free. What is the risk-free rate? And that is the 90-day or the 1-year T-bill. It's not likely to change, so we're not going to talk about it. But we are going to talk about delta. We are going to talk about gamma. We're going to talk about theta. We're going to talk about Vega. And we're going to talk about it from a theory standpoint like that, right, with rho. We're going to talk about it more from an application standpoint. And I'm going to go through it in a way that I found helpful to me in my own trading in order to make sure that we don't just understand what it means, but actually how do we apply it real time in our trading. So I'm going to go straight to the platform. And we're going to talk about what do we see when we see the Greeks. So again, if you have questions, just spit them out at me. I will get to them. If it's something you've been wondering about the Greeks, something you've had a problem with before, let me know. So the first thing is that the Greeks are basically a snapshot in time, right? Like right now, what I have here is I have, let me get a colorful pen to use. I have an option chain, and you can see that within the context of my chain, I have calls on the left, puts on the right, strike price expiration down the middle. And I've also asked it to show me the delta, gamma, theta, vega. Doesn't even bother with rho because it's just not that important, quite honestly. So I have delta, I have gamma, I have theta, I have vega on both sides. Now, let's start here. We see this. Let's pick an at the money option, right? Well, we don't have at the money right now on this one. Let me go to a different stock. I'm going to go SPY. SPY trades more options than anything else. It's a wonderful, wonderful stock for options. I'm still going to go out here, though, to the February options. Now, let's pick the at the money. Stock's at 331.30, so let's just go with this 331. Delta 0.52, gamma 0.04, theta minus 0.07, vega 0.39. What does that mean? Right? What does that mean? Remember that that's not even that valid because this is per share, right? This is per share, and one contract controls 100 shares. So the first thing you have to do is get rid of the decimal. Delta is 52 per contract. Gamma is 4 per contract. Theta is 7 per contract. Vega is 39. Okay, so we're going to start off with the theory, the definitions, and then we're going to talk about how they're applied, and we're going to finish by looking at the Greeks not from a option chart, but from a portfolio perspective, because this is where, well, I'll get to that later. This is where you can really start to understand things a little bit better. So let's start with delta. Delta starts with a D. Delta for dollar, right? Delta for dollar. How much? Now the Greeks, the first thing I'm going to tell you about the Greeks, they do not measure quality ever at any point. A delta of 0.5 is not better than a delta of 0.3. A delta of 0.7 is not better than a delta of 0.5. A theta or a gamma or a vega, one versus the other, they're not better or worse. They simply are a statement of expected behavior, right? And when we say that, what we mean is how would we expect our options to behave relative to a change in the underlying variable that each Greek represents? What does delta represent? A dollar. What would I expect for a $1 move in price? So if I have a delta of 0.52, which is pretty standard for at the money, that means I'm getting 50 cents on the dollar, approximately. In this case, it's 52. So if the stock goes up $1, I would expect my option to go up 52 cents. If the stock goes down $1, I expect my option to go down 52 cents. Again, it's not good or bad. It just is what it is. And I know you'll hear people out there say, oh, you should always buy 0.7 delta. And I used to ask, why? Well, that's just what they heard. Why 0.7? Well, because 0.7 is higher than 0.5. Well, then why don't I buy 0.75 instead of 0.7? And if I'm buying 0.75, why not 0.8? Because 0.8 is higher than 0.7, so that must be better, right? In that vein of logic. And if I'm going to buy 0.8, I may as well buy 0.9. If I'm going to buy 0.9, why not go for the gusto and buy a delta of 1? Because that's illogical. That doesn't make sense. 0.7 is not better than 0.5. Why would they say that then? Well, if you don't know what you're doing, it might benefit you to buy in the money. But that's just a representation. 0.7 is not better than 0.5. If you're going to buy in the money, because buying in the money means you're paying less for time. If you're paying less for time, that means that you're going to lose less in time decay, right? But I have no problem. In fact, some of my best trades are out of the money. And out of the money options, you can see your delta is going to be much less, 0.3 to 0.4, maybe 0.4 and a half. or 0.45. So it doesn't measure quality, it just measures behavior. Now, if I have one contract, then that 52 goes from 52 cents to $52. If the stock goes up $1, I make $52. If I have multiple contracts, I would have to multiply that by the number of contracts. Delta dollar, up or down the same way, right? That's all it is. Some people look at delta as a probability measure. There is a 52% chance that that option is in the money on expiration day as of right now. Yeah, okay. Oh, I wouldn't argue with that necessarily. But again, for me, that's actually not something that I'm interested in. I don't care where an option will be on expiration day. Why? Because I won't be there on expiration day. I'm not buying an option to be like, all right, let's buy this option and we'll check back in with it on expiration and we'll see how it did. I hope that's not what you're doing. I buy the option because I think, hey, this thing's about to make a move. And usually I want to have time left. I want to have a cushion that I can sell back just in case things don't go the way I want. But I have zero intention of staying in until expiration. Therefore, I really don't care where it's going to be on expiration. I only care where it's going to be during the course of the trade that I'm expecting. Okay, that's delta. Gamma. Now, there's no easy way to remember gamma. Just remember this. Gamma is a secondary Greek. Gamma is actually what is sometimes referred to as delta's delta. What does that mean? Mathematically, I want you to remember that the whole concept of delta, as far as math goes, delta is rate of change, right? How fast, that's literally what delta is from a math standpoint. How fast will the rate of change occur? Gamma tells us how delta will change. So let's just stick with this current example that we've been using. Delta is 52, gamma is 0.04. What does that mean? That means if the stock goes up $1, my new delta will be 0.56. And if it goes down $1, my new delta will be 0.48. Well, that stands to reason. As you look up, this is 55. As you look down, this is 48. So it's just telling you how fast will it go up or down. That's all it is. So do I pay a lot of attention to gamma? Not in the beginning. But as you get towards the end of a trade, they have something known as gamma risk. And I get it sounds like something out of an Incredible Hulk comic book, right? Gamma risk, the gamma rays. What does gamma risk mean? Gamma risk means that as time decays and there's not much time left, options become much more sensitive to the changes in price moves. So where there might have been a cushion a few weeks ago, the week of expiration, those options will behave much more violently. Well, not necessarily violently. That's the wrong word. Much more. What's the word? I'm not even thinking of the word. Much more sensitive. Much more sensitive. So that is the gamma. How much does delta change as the stock goes up or down? Vega. Vega is V for, oh no, I'm skipping theta. Theta is a T for time. This is a big one, right? Theta is a big one, really big one. Why? Because it helps us understand what's at risk as time ticks. Remember that time is the most consistent variable. So what does this mean? You'll notice that my theta is negative on both sides because this is looking at it from the perspective as a buyer. in order to reverse theta to a positive number, and we're going to get to the implications here in just a minute as we go through the definitions. But by default, theta will always be expressed negatively unless we build a trade that switches the sign. How do we switch the sign? Instead of buying the option, we sell the option, or at the very least, we become a net seller of options. So theta is time. So what does minus 0.07 mean? Well, minus 0.07, remember, is 7. So it's 7 cents per contract, or excuse me, 7 cents per share. Each contract controls 100 shares. Therefore, the theta is $7 a day per contract. So if I own 10 contracts of this option right here, I would be losing $70 a day in time. What do we know about time? It accelerates as we get closer to expiration. So it behaves in a somewhat exponential fashion. Let me just give you a brief chart of this, which means it's slow in the beginning and then it accelerates down. So the last week, we lose the most amount of time. That's why I told you I don't want, if I buy an option, I don't want to be in it the last week when it falls off that cliff. I want to own the option in this area and be out of it by this point. So I don't care where it is on expiration. That is directly as a result of understanding how that theta will work. So very quickly, if I go up here to an option that expires on Friday, the theta is twice as much. Right now, you're losing $14 or $15 a day. Now, if you have 10 contracts, instead of losing 70 a day, you're losing $140 to $150 per day. It is critical that you understand on every trade what is at stake as these variables change. Right? You're blind if you don't know the Greeks of every trade, and I'm going to show you here in a minute what I'm looking at here. Because right now, the problem is this is all very theoretical. Oh, look, this is per contract. But how many contracts do you have? Did you buy them or sell them? Did you do a spread? That changes everything, right? So we just want to have the basics down first. So theta, if you're a buyer of options, theta always works against you. You're always theta negative. If you are a seller, you are flipping the sign. And it becomes theta positive, which means time works in your favor. The longer you trade options, the more you're going to find yourself gravitating towards that concept. Why? Because in this situation, as you look at the variables, price goes up or down. That's one of our challenges, is trying to accurately predict price action. Volatility, which we're about to talk about with Vega, tends to work in an inverse correlation to price. As price goes up, volatility goes down. As price goes down, volatility goes up normally. Now, right now, we're in earnings season. Earnings season can throw a little wrench into the works, where we tend to see volatility rise simply because of higher expectations around earnings announcements. Yeah. So the volatility is measured and understood through Vega. Vega is a V for volatility. Vega tells us how sensitive are our options relative to a change in implied volatility. What I want you to notice, which is interesting, is that Theta and Vega on both calls and puts are the same. By default, they're both theta negative, which means they both lose from time. And by default, they're both Vega positive. What does Vega positive mean? Vega positive means that you make money if implied volatility goes up. Now, Vega is the one that is typically the least understood, right? Vega is a concept that when you're first trading options can be a hard one to wrap your mind around. So remember that one of the three components of option pricing, there's price, there's time, and there's implied volatility. Implied volatility is representative of what are the expectations. Remember that options trade on their own exchanges, their own markets. They have their own market makers, which means that options are subject to supply and demand. that exists outside of what the stock is doing. If everybody's buying the options, the price of the option is going to go up. Whether or not the stock is going up or not, it doesn't matter. If everybody's buying them, it'll go up. Well, that's what implied volatility helps us understand. Has everybody been buying the options, or has everybody been selling the options, or something in between? So Vega is, how sensitive are we to changes in implied volatility? Now, how do we put that all together? So let's go back to Delta for just a minute. This is one of the differences between the two. On puts, I'm delta negative. On calls, I'm delta positive. What does that mean? If I say, oh, I'm delta positive, what does that mean? It means I want the stock price to go up. If I'm delta positive and the stock goes up, I make money according to the delta. If it goes down, I lose according to the delta. So the sign that you're working with your Greek actually tells you the direction you want that variable to go. If you are delta positive, you want the stock to go up. If you are delta negative, you want the stock to go down. If you're delta neutral, right? Calendar spreads, butterfly spreads, iron condors. If you're delta neutral, you want the stock to stay the same. So this is part of how we go about picking strategies. If I look at a chart and I say, oh, that stock's going up, well, then I want a delta positive trade. There's a lot of different ways to get a delta positive. I can buy a call, I can sell a put. I can buy a call spread, I can sell a put spread. I can build neutral trades above me, above the price, which will give it a positive delta. So delta positive means we're bullish. Delta negative means we're bearish, right? Theta is always negative, right? Which means which way do we want time to go? Backwards. That's what I'm not saying it's ever going to. I'm just saying that's what we want, right? If you're theta negative, you want time to go backwards because it's hurting you every single day. Of course, that will never happen, but at least we have the ability to quantify how much money we expect to lose as time ticks away. So that if I think, hey, I'm going to be in this trade for 2 weeks, well, if it's 2 weeks and it's, $50 a day, you better be ready for what you're up against. That's $700 a time decay. You better know that the move you're forecasting has the ability to outpace that, or else you need to build your trade a different way. So understanding the Greeks can help you understand the best way to build a trade. If you've ever come to my trading room, you know how much I talk about deltas and thetas and vegas and what does it mean and what do we want it to do. So theta negative, it's working against you. All you can do is hope it doesn't take very long. If you create a theta positive trade, a theta positive trade means you sold something. You sold an option to flip the sign from theta positive to theta negative. If you do that, what do you want? You want time to tick. Every day it's in there, it's better, right? Every day you have that trade, it is a little bit better. Now, lastly, we have Vega. Vega positive means we want implied volatility to go up. If you want implied volatility to go up, it would stand to reason that you want the implied volatility to start low. This is where it starts to lead you to building the right trades. Low implied volatility actually equates to cheap options. If options are cheap, what am I inclined to do? I'm inclined to buy them. Then if implied volatility rises after I'm already in the trade, that will benefit me. So if I buy an option and earnings are going to report in a couple of days, then I would expect that the implied volatility has a very good chance of moving higher. And if it does, that's going to help my trade, right? Implied volatility will help my trade. So you'll notice Vega is positive on both sides. Anytime you buy options, you would rather implied volatility increases after you're in the trade. If you would rather volatility increases, what are you going to do? Only buy options when implied volatility is low. Now, hopefully your charts allow you to see, as I say that, mine doesn't have it on here. Let me just get it on real quickly. Now, there's got to be some questions after all that, right? Or does that just all make perfect sense? If you have questions, somebody else probably has the same question. So please be brave enough to ask it, because this is hard to wrap your mind around sometimes. Robert says it makes sense. Good. Excellent. Okay. So here I have implied volatility. So you can see on my chart, where is my implied volatility? It's not the lowest it's been, but it's definitely low, right? So when the implied volatility, when I see the implied volatility is low and possibly rising, I think to myself, hey, you know what? This might be exactly the right time to buy an option, right? If the implied volatility is high, if you were up here in the 20s, you would say to yourself, you know what? I don't think I want to buy an option now. Now you'll notice the implied volatility tends to spike up whenever we see price action drop, and then it takes a little while to recover. So here's the hard part is we might look there and say, hey, that's a great time to get in, and it would have been. The only problem is if you bought a call, you're slowing your profits down, because as the stock starts going up, the volatility is going down. As volatility is going down, remember, that's hurting you. You're Vega positive. You want volatility to go up. We don't want implied volatility to go down. So would there be a better way to build a trade after the market goes through a consolidation? Yes, most definitely. After a consolidation, I'm going to be much more inclined to do Vega negative strategies. When implied volatility is low, we want to be Vega positive. Buy options, maybe calendar spreads. When implied volatility is high, I want to be Vega negative. What is a Vega negative strategy? That's where spread trades come in, and they do very, very well, right? Can you explain the difference in IV impact on calls versus puts? It's going to be identical. That's what's very interesting. So I watch the VIX a lot. The VIX is an implied volatility indicator from a market standpoint, right? Based on the S&P 500. It's driven, when the implied volatility spikes, it's driven by people buying puts, right? So initially you're like, oh, I'm getting nervous. What am I going to do? You're going to buy some insurance. You buy puts. And as more and more people buy puts, the market makers are like, oh, look, everybody's buying my options. I'm going to raise the price of those options. So as they buy and they raise the price, that's also being reflected in the implied volatility. So you might think, well, why is the implied volatility going up on puts, but it should be staying the same on calls? Because if there's an imbalance in implied volatility, it actually creates potential arbitrage situations. There are hedge funds out there. They call them quant funds, right? Where they have these mathematical geniuses who go out and they find how to make money from these teeny little discrepancies in implied volatility, where you can sell the put, buy the call, and it basically what happens is as those funds see these discrepancies in implied volatility, they're constantly trading it. And what it does is it tends to create so that you'll never see it, right? You'll never see the imbalance. We expect implied volatility to rise and fall on calls and puts essentially at an equal rate. That's a great question though, because you're like, oh, well, is there something there for me? Well, if you're faster and better than a computer, maybe, but unfortunately, there's really not something there for us. Okay, let's keep going. Let's keep going. So let me go back now. Now I have, this is a trade we have on in our trading room. This is an interesting trade because this is actually a calendar spread. I bought and sold. So I sold January 31. I bought February 14, same strike price. That's typically a neutral strategy, but right now it's not a neutral strategy. Right now it's bearish. Why do I say that? Because this is my delta. Right here, this is my position delta for this whole trade. Now we're not dealing with this up here, right? That's the thing I want to point out. I don't like the Greeks necessarily from the option chain. I like to see the Greeks of my position. So let's take an actual trade and we'll say, what do the Greeks tell us? I have a delta of minus 100. What does that mean? It means I want the stock to go down. If the stock drops $1, I make 100 extra bucks, right? I want the stock to drop. My theta is 29. What does that mean? It means every day I'm in this trade, I'll make $29. Now keep an eye on that number, because as we get tomorrow, it becomes 32. Thursday, 35. Friday, 39. Then I get Saturday, I get $42 on Saturday. Then I get $47 on Sunday. So almost 100 bucks over the weekend. And by the time next week comes, I'm up to 50 bucks a day in time. So this is where, because I'm theta positive, it's working for me. I'm making money from time. In fact, time is the best possible thing for me. Let me show you this with a risk profile. Let me go back to today. So this is where I am now. How does this trade make money in this triangle? You can see I want this to move to this point here. If I did move to that point, you'll notice my delta becomes basically zero. Right now it's delta neutral. If this stock drops to 328, I'm delta neutral. I want it to stay right there. If it drops to the bottom side, now it becomes delta positive. Why? Because I want it to move back up. So delta tells me, where do I want it to go for me to make the most amount of money? So right now it's up here at this outer edge. I'd love for this thing to drop back into this range because I'll make more money there. And as I'm waiting for it to drop, I'm also hoping time keeps ticking, because as time ticks, the whole trade moves higher. Boom. Look at that purple line moving up. That's where I make money on this trade. This is a time trade more than a directional trade. Right now, it has a directional aspect. That's what delta tells me. I am bearish on this, at least somewhat. But the biggest variable I have is Vega. So if this stock were to drop back to 328, you might think, oh, that'd be great. You'd be up to 434. I'd be up to a lot more than that. Why? Well, because if the stock drops, remember that there is an inverse correlation between price and implied volatility. So if price is dropping, what's implied volatility doing? It's probably going up. And I might get 2% volatility. Let's just say 1%. Now, as volatility comes in, you'll notice volatility time affects the purple line. Volatility affects the whole trade. So as volatility comes in, you can see my whole trade is swelling. Right now, with 1% volatility, I'm making 600. If I get 2% volatility, I'm making 750, right? Why? Because implied volatility is pumping value into this trade. So if you've ever wondered why is it so important that we understand what's going on with the Greeks, this is why. I need to know what am I expecting from price, from time, from volatility? How am I benefiting from it? Or how do I protect myself against it if that is the case? So delta neutral. So what do I want? Let me go back to where we were. Let's make this back to 0. And let's get this back. I want this stock to drop, and I want implied volatility to rise. That's what I'm looking for right now. I don't need much. If this thing pulls back, even here to 329, 3 points, that's 1%, basically 3 points. A 1% drop over the next couple of days. Well, if I get it over the next few days, I might hold it over the weekend, because if on Friday it's pulled back to 329 and the implied volatility has risen by 1%, then all of a sudden over the weekend, I'm getting $70 a day now. So now I get Saturday, Sunday, Monday, and then I can say, great, on Monday, I'm going to shut this trade down. Beautiful. That's how they work. That's how these calendar spreads work. If you didn't know anything about calendar spreads, all you would need to do is come to these Greeks to say, what do I need to happen? What do I want to happen? Okay, now let's go look at this from a portfolio basis. This is just a trade by trade basis. Now I'm going to come over here. I'm going to put a beta weighting on this. What does beta weighting mean? It means that I want everything to be standardized according to the S&P. Right now, I can tell you all about this current portfolio. I've got a bullish trade on Apple in here, down a little today, but making money. Bullish trade on CMG, down a little today, but making money. Brand new trade on Lulu, just barely getting cracking. NVIDIA, just waiting for it to move. Then I've got a, what do I have? Calendar spread on IWM, butterflies on QQQ, calendar on SPY. So let's look at the net result of all of this, right? The net result of all of it. So when I look at my net deltas, now remember, I told you Apple was bullish. How do I know? Delta positive. CMG, delta positive. IWM is a neutral trade, but I want it to come down. SPY neutral, but I want it to come down. QQQ neutral, but I want it to come down. And then Lulu is bullish, delta positive. NVIDIA, bullish, delta positive. When you add it all up, what do I have? I actually have a pretty neutral portfolio right here, right? Well, if I have a neutral portfolio, how do I make money? Well, this portfolio is making $70 a day in time. So that's $350 a week, right? $350 a week on nothing but time value. And you can see that, well, we're basically looking to manage the trades individually, but also from a broader perspective as a portfolio. Now, the next thing to look at is the Vega. So I'm neutral, but what if the market dropped? Well, if the market drops, volatility is actually going to come in and help me. So this is giving me a Vega hedge. What does a Vega hedge mean? It means that if the market drops, volatility is likely to go up. If volatility goes up, I make $200 for every point that volatility rises. Great. That helps protect me. What if the market goes up? If the market goes up, I would expect my bullish trades to make me money. And my neutral trades, I would have to adjust. I can adjust those trades, right? You might be thinking, well, how do you make money? Well, I make money when I book profits on the on Friday. We booked $450 profit on one trade that went the right way directionally. If we get a minor pullback, we'll book profit on this trade. Maybe I'll tell you, to be honest with you, on this QQQ, I'm looking just to break even at this point. This one's gone a little against me. Possibly make some money, but if I break even on this trade, I can live with that. That's just sometimes the nature of the beast, right? But what I know is, I know this, I don't own any options. How do I know that without, well, I mean, I know it's my portfolio. How would you know that? Because there is not one position that's theta negative. Positive, 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 positive. I absolutely love to have time decay working in my favor. Why? Because time is the most consistent variable. I'll be honest, right now I feel pretty good about this portfolio. The market looks like it could be going through possibly a pullback. So if the market were to pull back, what would I want? I would want to hang on to my bullish trades. Hopefully none of them stop out, and I can sustain them while booking some gains if possible, right? If I book a big gain on SPY, lose a little maybe, but less than I have here, make a little on IWM, then hold on to my bullish trades as it starts to go back up. That would make sense. So overall, I am bullish, but my portfolio right now is neutral. Why is my portfolio neutral? Well, we have a market that seems to be hitting resistance. So that gives me the ability to protect against the pullback. So what do you want to know? On every trade you have, you want to know what is the delta. Are you bullish or bearish on that position? You also want to know, are you bullish or bearish overall on your portfolio? And how does that jive with your overall read on the market? If there's ever a time where you're like, man, I'm feeling really bullish, and you look in your delta negative, what does that tell you? You need to add bullish delta. And I'm looking to add more bullish delta to this portfolio. We unfortunately missed a signal that we were watching for on Tesla. If you didn't see it today, it took off again. We caught the last one. We were looking at this one, just didn't quite catch it. It moved. We were looking at it Friday, didn't put the trade on. Today it moved big. TSM is a stock that I think, let me show you. So what would TSM allow me to do? TSM would allow me to add more bullish delta. Where do I want to get bullish delta from? From bullish uptrending stocks that just made new highs followed by new higher lows. Now, if you notice, the implied volatility has actually come down quite a bit. So as I look at this implied volatility coming down, I might think, man, if it goes down a little bit lower, this is, other than this little blip right here, 19 is about as low as it goes. So I could buy options down there when they're cheap. And then if the implied volatility rises again, I could benefit from that implied volatility. So the implied volatility helps us understand, based on whether it's high or low and which way we think it's going next, what kind of trade we want to build. So let me go back. Now there has to be questions. There has to be questions. What do we think? Are the portfolio Greeks? So we have three different ways to look at the Greeks. We have an option chain, and that's the hardest for me, right? You're just getting these decimals, 0.5, 0.04, minus 0.08, 0.15, and you're like, okay, it doesn't mean much until I start to build a trade. Then I have trade Greeks. So each trade has its own net set of Greeks. What do I want from Apple? I want Apple to go up. I want time to decay. I want volatility to go, excuse me, down. I want volatility to go down. Well, where's implied volatility now on Apple? You'll notice implied volatility is high, right? This is as high as it's been in the last year. So yeah, I think that there's a chance that if it went anywhere, down would be the way that it goes. I'm not really worried about implied volatility going up from here because this is about as high as it gets. So I want Apple to go up. I make $47 for every dollar Apple goes up. I'm making about $6 a day. It's not a lot, but if I'm in this trade for 10 days and it accelerates, I might make $100 in time decay. Well, making 100 in time decay rather than losing 200, because when you buy options, your negative theta is much higher than this. So I would rather make 100 than lose 2 or 3, right? That's a $400 swing just in time alone. And I want implied volatility to drop. That's what I know. CMG, I want the stock to go up. I make $26 for every point it goes up. I want time to tick. I make $3 for every day I'm in the trade. I want volatility to drop. What do I want from IWM? I want IWM to go down, but I want time to decay still, and I want implied volatility to go up. The Greeks help us understand what type of behavior our option trades will make based on changes in the underlying variables. Here's something to keep in mind. The Greeks don't operate in a vacuum. I had a guy tell me one time, Scott, I think my delta's broken. I said, oh, well, deltas can't break, so tell me what you think is going on. Well, what happened was the stock went up $2, right? And he said, I have a delta of 50. I should have $100. I said, well, the problem is it took 5 days and you have a theta of minus 10. So 50 of it is there. I said, and the stock is going up, which means volatility is going down. And you have a 15 Vega. So as the volatility dropped by 2%, you lost 30 there. So you gained 100 from Delta, but you lost 80 from Theta and Vega. And the net result is you thought you would make 100, but you only made 20. That's not a broken Delta. That means that Delta is in a tug of war with Theta and Vega. I don't want tug of wars. I want everybody working for me. So if the stock is going to go up, I want to be Delta positive. Now, if I think it's going to move very, very quickly or very big, I could accept Theta negative, but I would rather not. I'd rather Theta work for me, and I'd rather Vega work for me. So your objective, as you understand these better, how do I get all the variables working for me? Or how do I get 2 working for me and make sure that 1 is not working against me? But it's got to be eyes wide open, right? I do not look at a trade without assessing the Greeks before I place it. I look at the Greeks as I place it and the impact it has on my overall portfolio. And I maintain perspective on a day-by-day basis. So that's it. We look at the Greeks from an option from an option chain. We look at Greeks from a trade-by-trade basis. We look at Greeks on a portfolio basis. And if you integrate those into your portfolio, like I said, one of the things that I would be looking for, like for example, if I look at it and I say, hey, this market doesn't look like it's pulling back, it looks like it's ready to run, then I need to change my Greeks. I would say, you know what? I'm going to take profit on my SPY trade. If I do that, I'm gonna take a minus 100 delta out of the mix, and now I'm positive 100 delta. Just like that, this portfolio is ready to go better to the upside. I might shut down QQQ or IWM. I might add additional bullish trades, because adding additional bullish trades will add additional delta to the mix. If I look at my portfolio and I say, gosh, I've got 6 trades on and they're all theta negative. Every day I'm getting burned and getting bleeding from time. Then I might say to myself, I need theta positive. How do I get that? Well, if I'm going to put some new bullish trades on, instead of buying calls, I'll do bull put spreads or naked puts, because that will add positive theta to the mix. If right now my Vega is positive 200, perfect. Why is that perfect? Because overall, and I'm going to bring up the VIX for this, because overall implied volatility is low. If the implied volatility were up here at 22, you can bet your last dollar that my portfolio would be Vega negative, not Vega positive, because I would be thinking volatility is more likely to drop now that it's high, right? So I need to make sure that my portfolio is reflective of my analysis of the market, from price action, from time, and from implied volatility. So there it is. The Greeks are just so important to understand. The better you understand them, the better you're able to manage your portfolio, the better you're able to understand what's likely to happen, and how does that look relative to what the market is doing. Last chance, you got 2 minutes. Any remaining questions? Otherwise, hopefully this gives you something to think about, something to chew on, as you trade options and understand them better. Thank you, Phil. I appreciate that. Yeah, hope I can get over my cold too, man. It's like I had the flu, got rid of it, and then it came back for a second bout. So I don't know. I don't know. I'm working on it. I'm fighting it. Someone said vodka. I don't know if that's true or not, but I'm gonna go give it a shot. All right, I gotta run. I will be back in 2 weeks. I have no idea what our next presentation will be about, but I definitely, I love these. Hopefully it's more options based. I love when I get to do options presentations. Good to see everybody. Thank you for coming out and hanging out with me for an hour. Again, the best thing I can emphasize, if you're gonna trade options, speak option Greek. It's that simple. Enjoy the rest of your day. As always, happy trading.